Okay. So, Nick, let's change gears and talk about the balance sheet.
Balance sheet, yep.
My personal experience with balance sheets is a bit of a painful one. I worked in corporate America for years. I was a marketing director. I was a regional manager, a director of sales, and we used a lot of profit and loss and income statements. And then I go off on my own, and I'm starting my own business, and I'm getting ready to talk to the banks, and they don't even really want to start with that. They really want to start with the balance sheet.
Yeah.
What's the difference between these two? Talk a little bit about them, and why are banks so focused on balance sheets rather than income statements?
So the balance sheet, again, it's a snapshot, it's a point in time.
As opposed to
the income statement is running over, like we said, first 3 months, 6 months, or a year, right? So that's an important differentiation between the two. But the simplest way that I've always explained it, and we talk with clients, is that you've got a balance sheet that has assets on one side, right? And then you have liabilities and you have equity on another. The assets are what you own. It's as simple as that. It's what you own. It could be the business vehicle. It could be your cash, right? Those are examples, your inventory. On the other side of the ledger, right, you have the liabilities. It's what you owe. So what you own versus what you owe, okay? And so what you owe could be accounts payable, right, to vendors. It could be a bank loan, things of that nature. And then the difference, if you look at the assets, and you minus those liabilities, is your equity, right? How much do you really own, right, as far as your equity? And very similar to even an example of a house, right? If your house is worth $250,000 and you have a mortgage of $200,000, you have $50,000 in equity. So you could look at it the same way on a business's balance sheet. Now the importance is because it does tell the bank or an investor, and even for your own self for planning, how much assets you have and how much you owe, right? And how much you're injecting or putting into the company. So it's very critical when you're measuring sort of how much cash is in the business, how much cash on hand, right? How you're collecting your receivables, how much inventory you're carrying versus not. And then ultimately on the liability side, what you owe. Because at some point, whether it's 30 days, 60 days, a year, or 5 years in the form of a bank debt, you have to repay that.
And that's one of the things I learned from my banker is this idea of short-term and long-term.
Yep.
And so if you're looking at your assets, which ones are short-term, which are more liquid?
Yep.
And now look at your liabilities and which ones are short-term. Now match up your short-term liabilities and your short-term assets, and are you able to cover your incoming and near-term obligations? Yeah, that was an exercise. And we use a lot of ratios for that. Now, is it important to have a huge ratio understanding, or are there a few of them we tend to focus on when we're going to talk early on?
So especially early on, and to your point, if it's under 12 months, it's considered short-term, right? If it's over 12 months on the liability or asset side, it's considered long-term, right? So that's an important differentiation, but the most common are like current ratios, right? And you're looking at, when you say current ratios, and you talked about liquidity, what could be easily turned into cash? So you're looking at your cash, maybe your inventory and your accounts receivable, and you turn those into cash. Can those cover what your outstanding payables are, or your accrued payroll, right? So banks, lenders, investors will want to know, is there enough cash to cover your liabilities in the short term? Because if there's not, you become insolvent. And oftentimes I'm asked a question, it's like, well, those are struggling companies, right? No, that can happen where companies are so successful, they're generating revenues and they're not managing their short-term assets and liabilities, and we call that growing broke. Growing broke, where you actually do not have the ability to fund the company anymore because you're growing so quickly.
Yeah, that was a shock for me when I found out that when we had the least amount of cash, we were growing aggressively. We had to fund what was next before what was next was generating any revenue. And if you have a big customer and they're saying, we're ready for this, and you say, okay, I'm not ready to deliver that, you have to invest to make that happen. That could be a cash flow drain.
It's called the working capital cycle. It's you manage the working capital cycle. And, I know that's not what we're covering sort of in depth here today. But when you look at it, how long does it take for you to collect your money from customers? How long does it take for you to sell your inventory? And then how many days do you have to go ahead and pay to your vendors or any types of manufacturer, whoever it is? And managing that cycle is very important. and negotiating those things up front will be important.
Nick, there was one more thing that matched up with the balance sheet from my experience in working with startups. This is this idea of required capital or a list of things that we needed to purchase to get started. It wasn't necessarily an ongoing list.
Yeah.
It was a startup list.
Yeah.
Talk a little bit about that. How's that fit in this conversation of assets and liabilities?
Well, it's on the balance sheet, right? Your startup capital is recorded on the balance sheet as part of your equity, right? So you would see that reported on that financial statement early on, right? That's how we start businesses. Whether it's $2,000, $100,000, $250,000, there's some startup capital that's needed. But creating a list that is forward-looking to say, okay, what do I need in the short term before I'm generating revenues and collecting on those revenues so I could have more cash coming in? You know, I need to have a list to go ahead and fund those startup costs.
Yeah.
And
Real
sometimes it's forgotten, and sometimes it's even thinking about, I'm going to need working capital. We talked about for 60 or 90 days. That could be part of your startup costs.
Yeah.